The new index is comparing the new index with the old index is basically comparing apples and oranges. What this index is designed to do is take into account all of the new things that we now know about growth and income in the future. So for example, the index builds into account what we've learned from the financial crisis and the resilience of economies. It builds into account what we know about the fourth industrial revolution and how economies must use the 4IR to drive their future growth. And third, it takes into account what we now know about human capital and social inclusion and how important those are for growth and development in the future. So the new index is basically taking a completely different approach. Now, Switzerland still does extremely well. It's number 4. It's past the 80% mark. We're basically looking at a new way of scoring competitiveness, with 100 being perfection towards the drivers of competitiveness and 0 being complete lack of perfection. And Switzerland scores above the 80% mark, and very few countries do so. So it is doing extremely well. It is an innovation powerhouse. Yeah. Where it does less well is things like...
It does very well in the labour market, clearly, the skills of the workforce. Mm-hmm. But you mentioned innovation. It's a bit lagging behind innovation, and I checked also the pillar of on institutions. Mm-hmm. It's not doing that well either here. Is the country ready for the fourth industrial revolution?
You know, that's essentially the main message here. On some of the softer factors related to innovation, there is more to be done. Yes, there are active labor market policies, but then again, you know, ICT adoption overall is not that high. The information and communication technology adoption overall is not that high. Yes, companies are incredibly innovative. They collaborate across academia and across governments. They work with each other. And at the same time, there's actually a lack of an entrepreneurial mindset. So for example, Israel is the #1 country in the world when it comes to having an entrepreneurial mindset, followed by the United States. Switzerland is much further behind.
Are you saying that Switzerland could take more risks?
There is a need for greater risk-taking if economies want to absorb more disruptive ideas, if they want to fail fast perhaps, but also learn fast from some of these newer ideas, and most importantly, great ideas that stay locked up in an R&D lab and never actually make it into a commercial product. That's not going to lead to longer-term competitiveness either.
The report points to openness as a key driver for competitiveness. If Switzerland cannot set a deal with the European Union on the so-called framework agreement, how much would that affect its competitiveness?
You know, it's hard to be able to say, but all else being equal, it is very clear that more open economies tend to grow faster, they tend to create more income for their populations in the longer term. But that statement has to be qualified. So yes, more openness is better. Yes, that leads to greater win-wins. But at the same time, that has to be complemented by policies that to some extent protect those individuals that may lose out. So specific pockets of society that would lose out. And Switzerland is actually very well set up for that, because it does have the right kinds of active labor market policies, it has the right kinds of redistributive policies, and so it could do very well with more openness.
But the failure of the negotiations between the Swiss government and Brussels, that could really impact the competitiveness of the country.
So it's going to be hard for me to be able to comment on anything very specific and current, and of course what we're looking at is longer term fundamentals. So we're not necessarily looking at one specific policy change or another, but really trying to look at various aspects of competitiveness that actually do go beyond tariffs and trade, that actually go into a transfer of ideas as well.
Let's turn on to the US, which is #1. How much of this is a reward of the Trump administration?
So the index is based on a redesign that we began 3 years ago. And the data, the 98 indicators that we look at across this index, some of them are perhaps very short-term policies that perhaps can be changed in the short term. But by and large, most of the index is about long-term change. And it's the result of successive governments over time, sometimes over decades, that have made the right kinds of investments. So to give you an example, the US does very well in terms of digital skills. Now, that is not something that's built overnight. That's something that happens over the long term. And on a more technical note, the data that is used in the index is the result of hard data from international organizations as well as survey data from the last 2 to 3 years. And so it actually does span a fairly long timeline.
So you're saying that the good ranking of the US is more the result of the past administration's building up on the forces, the strength of the US economy?
It's a lot of build up on the factors of productivity. Now, what remains to be seen is what happens in the future. And while the US is the #1 economy, doing extremely well, very close to that frontier of competitiveness, at the same time, there are some worrying signs. So, for example, the US is one of the lowest ranked economies among rich countries when it comes to health. Now, without basic health, a lot of economies are losing out. People are not more productive, and of course, it leads to lower social cohesion. Another aspect is freedom of the press. That's something where the US does much less well than a number of other economies that are in the top 20. So there's a number of things that point to these weak signals that essentially mean that in the longer term, the US may not be as well set up as it is today.
Maybe trade will be one of the topics which there will be some surprises. The ranking says it's important to have an open economy, but we know that the US has launched a trade war with China, has imposed tariffs on unilateral tariffs on its allies like Canada or Europe, and it's here in Geneva threatening to pull out of the World Trade Organization. But the index doesn't seem to care much about this.
Well, the index does take into account trade barriers, the complexity of tariff regimes, so it absolutely does take into account some of these measures. But I think what we're really trying to say is, yes, it is important to have an open economy, but it's important to also put in place the right kind of virtuous cycle around that open economy. So there are going to be people who lose out, and those are the people that do need some form of protection. And that protection is best provided by supporting those people to move on to their next availability for earning a living, rather than trying to protect very specific jobs or trying to protect the very specific products that are the result of those jobs. And so the approach we would suggest is really one that balances between inclusion and openness. And there are many very open economies in the world where you don't see that same pressure towards protectionism, and that's because they've actually provided the measures to protect people that are losing out.
How much really valid is the point to have just one figure to say that country is competitive where that one is not?
We're looking at 12 different pillars of competitiveness, and those range from very basic fundamental factors like institutions to education and skills to health to ICT adoption, the harder infrastructure of ICT adoption, all the way through to how your financial markets are performing, all the way through to your business dynamism, and all the way through to the innovation ecosystem. So that one figure is the rolled up measure of a lot of very complex ideas about what we now know creates a productive economy. So what we encourage countries to do is really break down the score, look at the 12 different pillars. The other big change this year is we're no longer saying that here's a prescribed path to development. We're not trying to wait between the 12 pillars. We're actually saying this is a zero basis. This is a sort of year zero in the context of the fourth industrial revolution. All economies should be trying to develop their own sequencing strategy, but at the same time, all economies should be trying to maximize across all 12 concepts.
One last topic is the environment. I don't see it clearly. It's not a pillar, one of the 12 pillars. And the US, which is top, the ranking is one of the countries which has the strongest footprint on Earth. How do you take this into account?
So we've dedicated one significant portion of the report to exactly this question. Is it possible to combine people, planet, and prosperity, or is there a natural trade-off? And I think while it's very clear that it is possible to combine inclusion with prosperity and that there should be no trade-off, with the environment, the picture is a little bit more mixed. It really depends on...
And the US is a good example.
And the US is a very good example. And so what we're suggesting is really a proactive approach is needed on the part of policymakers. It is no longer okay to say, let's grow, and then we'll try to afford environmental sustainability as a luxury good afterwards. This is no longer the case.
But still, the US is #1. The most competitive country.
We're looking at the factors of production, but then we're calling for the fact that these factors of production in the longer term are fairly meaningless if we're not putting into place measures that save our planet. And so there's a pretty strong call for that in the report.